We're over 11 months down in the S&P bear market and over 12 months down in the Bitcoin bear market. So the question that continues to surface for many investors, especially with the amount of fear, doom, and gloom in the markets right now, is how much worse can 2023 get? That's what we want to answer, at least clear the air in today's video. So make sure you are subscribed to the channel for more macroeconomic and cryptocurrency updates. This is your home on YouTube for this content. And of course, like the video up if you find some value. If you want to wait till the end of the video, I'll remind you again. Let's see what sort of value we get out of today's video. Some simple time frames and measurements based on the last 90 years of history, looking at the S&P to give us an idea, a forecast perhaps, moving into 2023. This isn't all roses. We do have to look at some of the worst case scenarios, but just to make it abundantly clear at the beginning of the video, if you are a follower and a subscriber of the channel and our cycles analysis here, my views have not changed. And as a little spoiler here, the data almost helps with our views to 2023 based purely on the cycles and basically the data that we've been given here. So with enough said, let's take a look at the short term before we move into the monthly chart to look at the macro for 2023. So the short term so far, we've just seen a rejection off the bear market downtrend. This is our fourth hit. This is the S&P, remember. So top in January, another peak in March, another peak in August, and then early December, call it November, December. Either way, we got the peak there. Now, the move down is now testing our first support level of 3,900 points. To the downside, this is a good level for it to hit for a test of support to hopefully build up some more case to then go and test those higher prices. You remember from the October low, the target that we are looking for here is around 4,150 to 4,200 points to happen at least in December, but this can flow through into January. But the main thing is we need to get to that price target to essentially flip us one of the checklist items to that bull case. Right now, we just have the date and a good low that has been set here with the market up significantly from that low. And that's going to be a key area that we maintain over the coming months, of course. Now, the next downside target, should the 3,900 level give way, which has been significant support and resistance since approximately June, is 3,800 points. That's the halfway point between the current cycle low and the top we just saw, so 3,800 points. If that breaks down, we're still okay, but things might just grind out for a little bit longer here. And then the next downside target is roughly around this particular low here and this low here. So call it around 3,700 points, as that is the macro, basically the weekly macro, not the monthly, but the weekly. That is the swing bottom for the market. So we don't want to see that level break down at 3,700. Otherwise, it could be a slow grind and potential test of the 3,500 point low. So that's all the short-term numbers here. These are the numbers to look out for. Basically, if the news gets extreme and these numbers don't break, you can basically just wipe all that news away. It is bad for people out there. We're not trying to say that it isn't, but in terms of being an investor and trying to make money from the markets, we have to separate those emotions and what we're seeing on media, social media, of how situations can be, and of course, what market participants are actually doing. Do as they do, not as they say, as one of those sayings goes. So we're down 338 days from this top. With the short-term stuff we've looked at, let's move across now to the monthly chart and start to measure some of these times in the market, these bear markets. So first thing is we're 11 months in, top to this level, and the low was actually in at 9 months. All right, but we're 11 months in. And should it get to that low point, if it happens this month, then that would be 12 months would be in a bear market, if it's to break down. So going back, what we're going to do now is look at each of the times where the market has basically halted and then had a pullback. And where does it sit at approximately 11, 12, 13 months from that top? And how much worse can it get to the downside over a period of time? The results will potentially shock you because we are seeing a lot of heavy press to try and get us to be even more fearful of the markets. But time does happen to wear out in people, and when they start to not fall for the fear so much, that's when tides start to turn. So let's have a look at how many we have here. Going back to 2018, we have a peak 11 months in called the low point. So you got a peak and the low. But if you wanted to even measure it just from this particular top, that's only 3 months. But essentially the market stopped moving in that January point. We had a few months down, another several months up, and then we had that drop into December 2018 before the market took off again for that next top in February of 2020. So 11 months, the show was over at that point there. The next one we saw going back was 2015. So approximately 13 months in, and you had a new high in that particular range. Going back to the low was only 9 months in, basically what we have seen now. So at 13 months, we started to push to new highs. And then at 14 months, we actually had a new all-time high price within this part of the cycle after the market had dumped into its 9th month. So let's go back now to the GFC, a time that a lot of people are referencing right now to be a similar period. But as you can see, just even from the months to a low, this particular low here in November was 13 from the top. And the fear is that we are going to experience these particular 2 months here where we had a lot of businesses failing and banks failing, and this was the absolute fear of the market. And as you can see, within 13 months, most of that had been cleared out of the market. So if we can get past January without getting to this particular period, the odds are that we won't see that sort of drop. 13 to the next low, so 13 months down to the next low, which was 17 months. So you had 4 months in between. The actual drop from low to low was not that much in terms of points. And as an investor, we're trying to make money from the price of the market, getting the timing right, but we're going to make money from the price. So from that exact low to the next low was only 10.8%. Call it 11% low to low. And pretty much very quickly from that low, it bounced out and was trading back within the range of that particular month. And so all the fear in this case was absolutely uncalled for because the market bounced out of that low very quickly and prices were never that low again. So what we're trying to weigh up here is the fear and the scare tactics from the data that media puts together and social media puts together, is it all warranted? And in most cases, it is not. It's just the pure data from the charts telling us it is not. At this point in time, back in 2009, it was extreme fear. And every single time we dipped, it was extreme fear. That is my living memory of that particular part in the market. And if you guys were in the market in 2009, let me know in the comments down below. It was pandemonium that the markets had to fall into another Great Depression, and it did not happen. So far, the worst case we saw was the GFC, but that is not the part of the cycle we're in. And as we'll see from another example, we're not in that stage of the cycle. And if you're unfamiliar with the cycle, this is the 18.6 year economic cycle. We're currently in this middle zone right here, leading into this last stage. So if we can get our understanding of where we are in the cycle, this is going to help us out a lot with understanding how much worse it can get, because some of the data points show that it should get a lot worse. But in reality, we're not there yet based on other key metrics. And in this case, we're following obviously the cycle here, being that we're in the mid-cycle, looking towards this later stage of the cycle. This will be important when we get to the 70s, but right now let's go to the 2000 to 2003 drop, 12 months down from the peak of September. Even though there was a slightly higher price in March, the market happened to grind away for 6 months before the fear started to enter the S&P. So we had October and November where the market started to close lower than the last 12 months of that market. So the fear had entered at this point, which is why we're measuring from September top. So down 12 months, should we get through December into that first week of January, which we're only about 3 weeks away, most of the move had happened. Most of the price, the money that is lost, had happened. Say it again. That is the point where most of the money had left the market. But the fear can continue for a long period of time. 13 months was the next low to the next low. And if we're to see a low form, which was October, this year in 2022, and we get another low coming up, the fear will continue. The fear will continue, but always keep an eye on the price chart, because from one low to the next low was the least amount of losses in that entire move. It's still 19% loss here, but it's the least when you compare it to the peak, to the first lot, which is the most extreme in terms of emotion and market sentiment. It was double in that first period. So going from the low to the low in the next round of 13 months, it was half the amount of losses in terms of money. So two of the worst cases in some people's living memory didn't really result in that much more downside in terms of prices. In terms of time, it can go on, but maybe in this case, we grind away at similar prices. Either way, if it's the worst case and we go another 19% down from that low, that is still the possibility as a worst case, all right? So moving back in time, let's go back to another few of these cycles to have a look at it. 10 months in the 1980s drop saw the most amount of losses. Go forward into 16 months, and basically all the losses were done. So if we can get through the next 5 months into the late half of the first quarter, somewhere around March, April, most of the losses within a bear market should already have been known. And October could be that low, which means most of the losses would have already happened in the market. Let's go back again into the 70s. And this is one of the key points here where the losses happen in the second half. And it's good to see some of these models where they don't work out 100%. You never want a model that's 100% because eventually it breaks. We've seen that time and time again. There are no models that are 100%. And in this case, for the 1970s, we go to the next low, a lot of the losses happened in that second part. So there was another 8 months from the first 13 months, it was down 32%. But if we remember where we were in the cycle, this was the end peak of the 18.6 year cycle. This was where everyone had piled into the market and we had a collapse after that particular point in time. We're not there yet. Therefore, this is not the same part of the cycle that we're in. But this will come, and this will come at the next major crash, which we're expecting sometime after 2025, 2026. This is when things will get really, really bad. But people will miss it because the market will survive what we're going through now. People will be complacent and forget history. And then when the things start to get bad, that will be the one that is really, really bad. So I'm not a perma-bull forever. There are going to be times where things get really bad, but now is not that time based on what we've seen in terms of history and our cycle analysis. Go back to the 60s again. So 68, 13 months in, almost the majority of the move had happened at that point. Let's take a look at it in terms of percentages from the top to the bottom there. You got about 23%. And then for that next stage of the move, which was only 1, 2, 3, 4 months later, you have the next low to the next low, which is 18, 19%. So most of the move happened at the top, but it was very similar to the downside as well. But if we can get through the next few months, that would then mean that in almost all cases, within 17 months from the top, most of the price losses have already happened. 17 months from the current top leads us into that quarter 1, early part of quarter 2 of 2023 as well. So we can survive that. Basically, most of the losses are done. Now, you came to this video for 90 years of data, but it is dragging on a little bit. Let's take a look at the last few. 60s, 13 months in, the losses happen, V-shaped recovery, 13 months, almost back to that same price. Go back to the early 60s. You got 10 months and you had the higher low form, essentially where we're currently at. The low formed in that period within 6 months. Go back to the late 50s into 1960, 13 months, top to bottom, go 14 months, and the bottom was in. Basically, not much price difference between the 13th and the 14th month. Go back into the 50s, top to bottom of 13 months, most of the losses had happened, and the final low had happened within 14 months. So there's your next bear market. You're here for 90 years. Let's keep going back in time, go into the 40s. This is after the Second World War. Moving on to this part of the cycle, 14 bars, top to bottom, basically most of the gains, the losses had happened in that period. All the way back to the Great Depression, 14 or so bars, and where I'm looking at these pricings is the swings in the market. So 14-ish bars, but as we've said, we're at 11 months in, so 10, 11 months, that we had about half of the move happen at the Great Depression, and then the following half within that following 10 to 12 months as well. But just remember, going back to our 18-year cycle, that was at the end of the property cycle, not within the middle, which is where we currently find ourselves. So with a little over 90 years of data that we've gone through, the worst case scenario we could see was the tech wreck, something that was the most similar to what we currently see today. And what the data shows is within the first 12 months of the move, most of the price losses had already happened. So anyone trying to sell out to then buy back at lower prices essentially missed the boat, missed selling the top to get in at the bottom. And that's what we're mostly worried about here, because what we want to do is buy somewhere around the lows and sell somewhere around the tops, because like most professional investors do, they just want to take a chunk of profits out of the middle. They're not interested in buying the exact low and selling the exact top. That's a fool's game, and most people lose money trying to do that. The idea is just to take chunks of profit out of the middle of the market. Now, if that wasn't enough to get you excited for 2023, you can go back and check out some of the videos on my channel looking at presidential cycles. So in particular, the third year of the presidential cycle, which is next year, 8 to 9 times out of 10, depending on which data you look at, we have a price increase in the S&P leading into that election year. That's another big piece of data there. I also have some more data to get you excited, but make sure you do check out, if you're enjoying this type of analysis and the macro look at the markets, check out our investors report. Link is in the top of the video description here. Just subscribe to that. Plus, we have huge discounts on our memberships going on at the moment. So this is for our monthly memberships. The link is in the top of the video description. Make sure you do subscribe to the newsletter, and you will also see those discounts coming out as well. So the other piece of big news here within this worst case scenario of 2023 is, what is the probability of the S&P delivering a positive return a year from now? So this is coming from account Seth Golden here. Answer, 90% or 11 out of 12 times. After 150 days below the 200-day moving average, finally crosses above it. The only time S&P was lower a year later was 2002. So that was one of the cycles that we previously looked at, and it was lower at that point. But we've also covered in this video that even in 2002, with that tech wreck, if it is to repeat and we get the worst case here, the second part of the down leg was nowhere near as bad as the first part, which is what we've already been through for the S&P. And so what has happened in the past, if we look to the positive results here, is that the market had gone up 9 out of 10 times 12 months after that market crossed the 200-day moving average, which is what we just saw in the last few days for the S&P. There's so much more data I have to go through on the channel, but this video is long enough, so make sure you do subscribe with the bell notification icon. Plenty more macro content coming up, plus an update of Bitcoin and cryptocurrencies very regularly through this bear market. So what does this all mean for Bitcoin? Well, we have been down for 12 months. And if anything is to repeat like it did in the previous cycles, we should see some sort of continued grinding out of a low pattern here for BTC over this coming period. And if it is to extend like it did with the S&P, looking at those lows, potentially into that Q1 period. So that could look anything like where we currently sit here into March. Maybe we see a slightly lower low in December, which we've covered here on the channel as well. We've covered those macro moves on our December prediction video right here. So go and check that out after this. There'll be a link to it in the playlist popping up on the side. But as for this period here, probably we're still in this grinding process. And what I have coming up also is a Wyckoff analysis update of this particular zone on the macro time frame for Bitcoin on that weekly chart. So make sure you stick around on the channel, check out the videos popping up on your left-hand side here, and join me on Twitter and on Instagram for more macro, cryptocurrency, Bitcoin, and stock market updates. I'll see you guys at the next video. Until then, peace out.